How much cash flow should your rentals actually be making? You've probably heard $100 per door, 10% cash on cash return, or just as much as possible. But what do those numbers really mean? And are they realistic in 2025? In this episode, I'll show you how to measure cash flow, what enough actually looks like, and how to adjust for today's market. Hey there, I'm Chad Carson. You can also call me Coach Carson. And on this channel, I teach you how to use real estate investing to achieve financial freedom so you can spend your time doing more of what matters. Now, towards the end of the video, I'm going to share how much cash flow I actually need to make a good deal right now in 2025. But before we could talk about how much cash flow is enough, we've got to get on the same page about how to actually measure cash flow. And I'm going to make this really simple. You can think about measuring cash flow in two different ways: the amount of cash flow and the return on your cash flow. And then with each of those, you can also think about the amount of cash flow with no mortgage or the amount of cash flow with a mortgage. Or you could think about the return on your cash flow without a mortgage and the return on the cash flow with a mortgage. So there's four different formulas, and I'll explain each of these really simply. Then I'm going to give you an example to show you how it works in the real world. So if you want to know the amount of cash flow and you have no mortgage, there's a formula called net operating income, also known as NOI, which I think is the most important formula to be able to figure out in the real estate investing business. And it really simply is this. You just have to take the rent that you can collect on a property and you subtract all of your operating expenses. So this is all of your expenses except for your mortgage, because we're assuming right now that you have no mortgage on the property. So operating expenses include your management fees, your taxes, your insurance, your maintenance, any capital expenses, vacancy expenses, things like utilities if you happen to pay the utilities for your tenants. So everything that would come off of the bottom line, all of your expenses, what's left over is your NOI, or your net operating income. Now that's without a mortgage, but if you want to know the amount of cash flow with a mortgage, it's just one more step. You take the net operating income that we just figured out and you subtract your mortgage cost. So typically you can figure that out with an amortization or a mortgage calculator. That's the principal and interest that you'll pay on your mortgage. So the NOI minus your mortgage cost, what's left over is your net income after financing. And most people just call this your cash flow. So those are two different ways to figure out the amount of cash flow, but many investors also want to know the return on our cash flow. We want to know how much are we going to get back in the first year based on how much money we put into the property. It's a good thing to know, right? So there's two different ways to think about that as well. Without a mortgage, you figure out a formula called the unleveraged yield. This is very similar to a cap rate. It's basically the same formula. You might have heard of a cap rate in real estate investing. It's just used a little bit differently. So an unleveraged yield is the ratio of your net operating income that we just figured out. So the cash flow that your property produces without a mortgage divided by your total purchase cost. So this is your price plus your closing costs, any repairs you had to put into the property. So everything you have invested in the property, you want to figure out how much cash flow am I getting back in year one divided by that purchase cost. That's the unleveraged yield. You can do something very similar though with when you have a mortgage on the property. So if you put a down payment or some other cash into the property, you could just take the cash flow in the property, the net income after financing, and divide that by your cash invested. And that gives you a ratio called your cash on cash return. Now, I know formulas don't mean much unless you can see how they're applied to real life. So I want to show you a simple example where you buy a property for $250,000. Now, for my folks in high cost of living areas, I know that prices are not even close to that in your area. We're going to cover that a little bit later, but stick with me there. The math works wherever you are. So if you buy a property for $250,000, let's assume you put $75,000 as a down payment. That's 30% down. And so you get a mortgage for what's left over, $175,000. And let's assume you can get a 6.45% interest rate. And I know those are fluctuating a lot as well. So the first thing I'm going to figure out in this is the net operating income. Remember, that's kind of the core formula we want to figure out. Assuming we had no mortgage on the property, we start off by saying this property will rent for $2,000 per month. I did some research with that. Maybe I talked to my property manager, looked on online rental estimates, and I figured out that my property rents for $2,000 and I have operating expenses of $800 per month. That takes a little bit more figuring out. You got to actually look up the taxes, the insurance, the maintenance, and make an estimate there. I'm giving you kind of a rough number at this point. So $2,000 minus $800 means you have $1,200 per month in net operating income. And I actually want to figure that out on a yearly basis first. So I multiply $1,200 times 12, and I get $14,400 per year. And stop and think about that. That's the amount of money our little real estate investment business produces every single year if it had no mortgage. That's like the profit or the cash flow that our business is producing. So that's step number one. That's the first formula that we wanted to figure out is 14,400 per year of NOI. But I also want to figure out the ratio if I had no mortgage on this property. And so I divide 14,400 divided by 250,000 bucks. That's my total purchase cost for this property. And I'm going to get my unleveraged yield of 5.76%. Now, I'm going to talk about this number a little bit more when we see how this is relevant to 2025 and how you actually use this number. But this, I'll just say for now, this is a number I run, a formula I run on every single property, including the NOI, so that I can compare it to other properties in other areas and also compare it to cash flow in other investments. It's a way to sort of simplify the analysis without putting the mortgage on the property. So that's step number one, NOI, and then figuring out the unleveraged yield. But then we also want to figure out how much of a cash flow we're getting with a mortgage on the property. So there's just one more step. We take our NOI, in this case, our monthly NOI of $1,200 per month, and we had to use a mortgage calculator to figure out that a $175,000 mortgage for 30 years at 6.45% gives us a principal and interest payment. So there's no taxes or any escrow. We're ignoring the escrows if it happen to have an escrow on your mortgage. We're just saying $1,100 per month, and you subtract that from $1,200, we get a cash flow of $100 per month or $1,200 per year. So we figured out our amount of cash flow without a mortgage, our amount of cash flow with a mortgage. And now we have one more formula to figure out. We want to figure out our cash on cash return. We're going to take this cash flow after paying our mortgage payment of $1,200 per year and divide that by our total cash investment of $75,000, and we get a cash on cash return of 1.6%, which is pretty low compared to historical numbers. But as we'll talk about, this is actually pretty normal for me on many deals that I'm looking at in 2025. So now we're on the same page about how to measure cash flow, either the amount of cash flow or the rate of return of cash flow. But the question still stands, what is a good amount of cash flow, or what is a good rate of return, or a good cash on cash return? And I'm going to answer that question by saying it depends on two main things. Number one, it depends on the location where you're buying a property. And number two, it depends on the type of financing that you get to buy your investment. Now, I want to tell you a principle that you probably already know, but if you buy in different locations, you're going to get different amounts of cash flow. So those of you who live in high cost of living areas, you live in New York, you live in San Francisco, or a lot of the big cities out there, you know that the prices are a lot higher in your location compared to the rents. And if you go to another location, you go to the Midwest or parts of the South or more small towns in the United States, you're going to find the rent is much higher compared to the price that you pay for a property. Well, that's just another way of saying that the cash flow is different in those locations. And I want to demonstrate that by actually showing you a chart here of cap rates for multifamily property in early 2025. Now, cap rates is just a fancy term. It's a commercial real estate term that's very similar to the unleveraged yield that we just figured out when we looked at earlier. It's a way of measuring cash flow, assuming you didn't have any debt on the property. So it makes it easier to compare from one deal to another because people use different kinds of debt, different amounts of debt. And what you see here is that if you look at different regions of the country, so starting with New York all the way down to Chicago, Atlanta, St. Louis, Detroit, you're going to have different rates of return that investors expect. So what you see here is just the market rate. So of all the people who bought properties, multifamilies in a Class A location in New York, on average, they expected about a 4.25% cap rate. That's the amount of cash flow they wanted. But if you bought the same type of location in Detroit, they demanded a 6% return. Now let's translate that to real numbers. If you spent $1 million in Class A location in New York, they would want $42,500 in cash flow. They spent the same $1 million in a Class A location in Detroit, they would expect $60,000 in cash flow. So just moving from one region to another, you have different amounts of cash flow on average. So if you're out there buying and competing with other investors, this is what you're competing with. But the same thing applies within a location. So even within New York, you'll have Class B locations. And by the way, CBD just means the commercial business district. So this is just one part of town to compare apples with apples in these different places, like the downtown business district. So if you go from Class A to Class B is typically a little bit older, maybe not quite as nice. And then Class C is definitely the older properties. They have a lot more deferred maintenance, maybe not quite as good a location. So you go from 4.25 to 4.5 to an estimate of about 6% in a C location. So in the same city, people investing would expect $60,000 worth of cash flow if they spent $1 million on a property in the Class C location. And I've actually done this even in my own location in South Carolina in Clemson. I've looked at different properties that I own, and I own some properties in what I consider a Class A location, right near the downtown, right near the university. Other properties that are more of a Class B location that have a little bit less cash or a little bit better cash flow than they would in a Class A location, at least when I buy them. And then Class C is a different location, more of a blue collar location. I have a house and some trailers in this specific location, and they make much more cash flow compared to the price I pay. So you might ask the question, if these properties in a Class C location, let's say in Detroit, make more cash flow for the same amount of money, why would you even buy a Class A property in New York? Because investors do it every single day. Did they make a mistake? Are they looking at it differently than you? And the answer is there's a lot of reasons that they might do this, but a couple of main ones are that number one, they might expect the growth rate of this property to be more than in a different location. So perhaps, I don't know exactly what the numbers are, somebody's buying a property in New York City, but they might expect that the growth rate could be 5%, but so that the rents and the price over the long run might grow at 5%. And so combined, if they make 4.25% from the cash flow and 5% from the growth, they might expect to make a 9.25% return total. Of course, that's speculative. You don't know exactly what's going to happen, but they might have reason to believe based on population growth and other supply factors that that might be true for that region. And then they might look at Detroit buying an older property, which might have a lot of capital expenses and a lot more hassle, things they have to deal with. And they say, you know what, we can make 7.25, but we might not expect it to grow but 1 or 2% in this area over the next 10 years. And so for them, they say 7.25% from the cash flow and another 1 or 2%. Maybe they're expecting to make an 8 or a 9.25% total return. So this is the kind of math that investors might be thinking. If you make more cash flow, it might be because you're going to make less in other areas. If you make less cash flow, it might be that you're either going to make more growth or maybe you value something else. Like it's very easy to sell a property in a Class A location. Typically, there are more investors, there's more money. That's one of the reasons the prices have been driven up. So there's just other benefits to owning it. And you have to think about it from your own standpoint of saying, what am I willing to deal with? Where am I willing to invest? And what kind of cash flow do I want in order to buy a property for my own investing? So hopefully you can see what a big impact different locations have on your ability to make a positive cash flow on your rental property. Because really a big part of the real estate investing game is understanding these differences and also taking advantages of changes between these different locations. So for example, one of the best ways I've been able to build wealth with my own properties is to start off finding C locations in my town. And maybe you buy a property that has C like cash flow, but then anticipate or speculate that this location is going to get better. It might be in the path of progress. And over time, if you buy and hold in that property, you make C cash flow for now, but then it gets better and better and better and grows into a B property. So the value of that property and the rents go up. So you get kind of the best of both worlds. You can do the same thing in B locations, buy them with a B cash flow today, and they grow into A locations later. So that's a more advanced way of looking at the location and making cash flow. But there's one other factor that I mentioned that has a huge impact in addition to location on your cash flow, and that is your financing. So I want to give you a couple of examples where we add financing to the mix, where we talk about different interest rates and different terms to show you how much that affects your cash flow. So in this example, I want to assume we buy properties for $1 million. And remember, we had some properties that maybe had a cap rate or a yield of 5%. Then I'm going to show you another example where you have one that has 7%. So in this example, we make a $50,000 per year net operating income. We figured that out just because $1 million purchase price times the 5% cap rate or yield equals $50,000 or $4,167 per month. And we're going to go borrow some money to do this. And in this case, we're going to make a big down payment of $400,000 or 40%, which by the way, I found in these areas where you get about a 5 or 6% yield in today's market, you're having to put a much bigger down payment in order to not have a negative cash flow. So this is very typical on these higher quality properties. So in this case, we put $400,000 down. We get a $600,000 loan. I'm going to assume it's 6.45% interest rate for 30 years. And if you use a mortgage calculator, that'll tell you that you have a $3,772 payment. So when you do the math on this, 4,167 minus 3,772 gives you a $395 per month cash flow or net income after financing, or on an annual basis, you have $4,740. Now remember, you invested a $400,000 down payment. So that's not a really high cash flow compared to that amount of money that you put in. You're not getting a lot of money back. And let's figure out how much you're getting back for your cash on cash return. And so you just divide 4,740 by 400,000 and you get a 1.2% cash on cash return. So if you're someone who's just looking at cash on cash return, you might say, I'm not going to do this deal because this is a really low rate. But there are investors, including myself, who do deals today with numbers similar to this. So there's got to be another benefit. You got to have another reason for doing this. So what might the reasons be? In my case, I often look at the equity of the property. So I bought it for $1 million, but I might want to have some way to add value to the property. So maybe there's another lot that I can carve off that has extra value. So by me doing a subdivision, I could have my duplex or my property on this, my building on this lot, and I carve off another lot that also has another $200,000 in value. And so instead of 1 million, it's actually worth 1.2 million. And then maybe I build another property there that has some more value. That's one example of adding value, but you got to make money somewhere. So if you're not making a lot of money on the cash on cash return, you're either making it by forcing the appreciation on the property, adding value, or maybe you're buying in a location where you're speculating that it's going to go up in value even more. So this $1 million property, if you think it's going up at 5% per year or something like that, maybe in 10 years, that property's worth $1.5 million or $2 million. And so you're making your money just by making a little bit of cash flow today, but the value of the property and maybe the rents of the property are going to go up. So you'll make much more cash flow and much more equity over time. That's how some investors look at a deal like this. But not everybody is excited about that. So other investors might buy properties in different locations that make a 7% cap rate. That might be the market cap rate or the market yield that you see there. And so in that case, let's say we bought the same amount of property, $1 million worth of property, and you put 400,000 down, the same thing. You borrowed 600,000, so we had all the same financing as the prior example. But the main difference is this deal is making more cash flow, $70,000 per year or $5,883 per month. So it makes about a $2,111 per month cash flow or $25,000, a little bit over $25,000 per year. Really big difference, right? A 7% cap rate property versus a 5% cap rate property with the exact same financing makes a much bigger cash flow. And if you want to figure out the cash on cash return on that, 25,332 divided by 400,000 equals 6.3% cash on cash return. Now, I want to say a couple other things about the math of buying properties with financing, because you might look at this and say, like, this is just not good enough. I'm not going to invest in real estate. I'm going to make a 1.2% cash on cash return or a 6.33% return, even on a property that's in a not as good of a location. Like, that might not be good enough for you. So you have to think about it like an entrepreneur who says, what can I do to the property to make more money? So I showed you an example of being an entrepreneur and adding value. That's one way I have bought properties like this, where I can try to increase the value of the property. But the other way you can think about this is if this property, the market value makes a 5% yield, what if you could buy it at a discount? I'm not saying every seller will sell it to you at a discount, but maybe you could buy this $1 million property because it needs some work. Maybe you could be all in for $800,000, get a 20% discount on the property. And if you do that, what that means is you could either put less money down. Instead of $400,000 down, you could put $200,000 down and have the same exact financing, or you could put the same amount down and just have a much lower loan balance and make more cash flow as a result. So the price you pay for the property makes a big difference in the amount of cash flow or your cash on cash return. And this principle applies the same way with the financing. So you could try to buy the price at a lower price, but you could also try to get financing at a lower price. So this is a big part of getting creative with seller financing or lease options, different ways to cut the cost of your financing. So instead of 6.45%, even though that's what the banks might lend you money at, if you can get seller financing or private money or some other source of money that's at 5% or 4% interest, you can make a much bigger cash flow even at a higher price. So the price of the property and the price of your financing are a big deal. And that is how many investors, even if they're not making cash flow on a retail basis, like going out to the bank and doing a normal loan, they get more creative and they negotiate harder on the price and the interest rates to try to make their cash flow even better. So we've really gotten into the weeds of the math and the formulas and the case studies of cash flow. And I hope that's been helpful for you. But now I want to pull all of that together and talk about how you can actually apply these ideas to today's market. And more specifically, I want to give you some insight on how I'm approaching it and how I'm thinking about cash flow to buy my own investment properties. And so I have 5 different tips here. My first tip is to set goals based on locations. So set cash flow goals. And you can decide what formulas are most important to you. A lot of people use cash on cash return or just a raw cash flow number, like how much cash flow you're making total. I like to use the yield number, the unleveraged yield. That's one of the most important kind of metrics I use to start off. That might be my first metric. And then I also like to look at a total amount of cash flow. As I've explained here, cash on cash return isn't always going to be the best metric in today's market. I like to look at my total return, including other ways to make money. But using those 2 formulas, I might look at a property, for example, in my location, a single family house in a B or B plus location. In today's market, I might make a goal of 5.5 to 6% as the yield that I'm looking for, kind of as a bare minimum. And I also might look at a cash flow of at least $100 per month. And $100 per month is not going to be a lot to write home about on a single family house, but that's what I'm looking at today. And if I lock in a 30-year mortgage and I'm in a location that I think is going to have good anticipation for growth, it might not grow this year, it might not grow next year, but over time, I bought a property in 2009 that the rent was $950 back in 2009, and it's at a really good location. Today, that market rent is $1,800. So it's doubled in the amount of rent. And so I'm making a much bigger cash flow because my mortgage payment is the same today as it was in 2009. I locked in that payment. So in good locations, I'm anticipating that getting better over time. But then if I buy in another location, more like a C location, that's more of a cash flow location, I might have a different unleveraged yield of like 7 to 9, maybe even 10% on those properties. So I do want more cash flow today if I'm have to have more of a project, more of a fix-up project. And so you just have to figure out what's available in your market, what the market rates are, and then try to do a little bit better than that, or try to set some kind of goal that makes sense for you. My second tip is to get used to making big down payments. This is just part of the math of what we're looking at. If you're looking at a property that has a 5% yield, but your cost of financing is 7%, you have negative financing. And so you can't borrow a lot of money and still have a positive cash flow. It's not mathematically possible. So you have to make bigger down payments. It's the nature of today's investment climate is that if you're going to use leverage, you're probably going to have to make a bigger down payment and borrow money at market interest rates and have a lower cash on cash return. That's part of what we're looking at today. But if you're not satisfied with that, this is what maybe a turnkey or a retail investor might have to deal with, and that might be okay. But if you want to be more entrepreneurial, which I recommend, you don't have to necessarily accept those lower cash on cash return rates, but you're going to have to do something better than normal. You're going to have to either buy it at a lower price, maybe 20%, 30% below the full price by finding a situation where someone has a property that needs a lot of work or they're motivated and they just want to get rid of the property. You have to look at a lot of properties to find one that makes a good deal, but that might be part of your strategy is to have an acquisitions funnel to find really good properties at good prices. Or you might get creative on the financing, or you might do both. You might look for sellers who are willing to seller finance the property at a 4% interest rate. Maybe you can find somebody who's willing to lease option you the property. It would effectively would be a lower monthly payment. Or maybe you can get creative. I have a friend who's buying properties, new construction properties in Texas right now, and he's negotiating with the builders who will buy down the interest rate from 6.5 or 7% down to 5% by contributing some of the closing costs to buying down that rate. The point is, if you want to make more money in real estate, you either have to buy low or you're going to have to borrow low. Those are the 2 ways to be an entrepreneur. A fourth tip, which we didn't talk about earlier, is to find niche strategies to make more cash flow. Most of what I ran the math on today was on the vanilla, regular, long-term rentals of real estate investing. I like those types of properties. I think you should always buy a property so that it makes sense buying as a long-term rental, but maybe you get an average return as a long-term rental, but you have another strategy where you can do a short-term rental, where you can do a rent by the room, and you get more cash flow as a result. So these are effectively businesses that fit on top of regular old real estate. So you're having to do a little bit more work, a little bit more systems, you might have more turnover. Like with short-term rentals, it's much more the hospitality business. But if you want more cash flow, you might be willing to put in a little bit more effort, put in a little bit more work in order to make more cash flow. And then you still get the benefit of the property growing and doing everything else we've talked about over time. And then my final tip is Be patient. Cash flow is something that we all want, but really one of the biggest questions is, when do you want your cash flow? There's a lot of ways to make money in real estate if you're patient. I look at it like planting a seed. You plant a seed today, and if you were to plant a seed of a fruit tree, you wouldn't expect this fruit tree to produce a bunch of apples or a bunch of oranges 1 year from now, or 2 years from now, or even 3 or 4 years from now. Fruit trees take time. You got to be patient. You got to water it. You got to nurture it. You got to let nature take its process. And many of my best real estate investments did not look like a home run in the very beginning. They didn't make home run cash flow from day one, but now 10 years later, 15 years later, 20 years later, those are fruit trees that are paying me dividends for the rest of my life. And so cash flow works the same way. If you're a patient investor, if you buy good quality properties, if you at least make sure you have some cash flow today and you're buying in the right locations, those fruit trees can grow and can produce cash flow for you for the rest of your life. So all throughout this episode, I did a lot of back of the envelope math where I wrote on the whiteboard and did formulas. So if you'd like help using those formulas for yourself, I actually have a free cheat sheet that you can download. And you can get just a list of the formulas, how to use them. That way you can apply these to your own properties. And if you want to see me do all of that math with another video, I want to recommend my next video where I go into how to analyze a rental property with no calculators, just using back of the envelope math. It's one of my most popular videos on my channel. I think you'll like it. And if you're watching on YouTube, you can click on the thumbnail above me here. Or if you're listening to the podcast, you can click on the link in the YouTube or the podcast description below. Thank you so much for being with me in this episode. I'll see you next time.